Hello and welcome to your investor update for November. I'm Elfin, the CRM manager here at Nutmeg. As we're back to working remotely, I'm joined via Zoom today by Brad Holland, our Director of Investment Strategy. Hi, Brad.
Hi, El.
Financial markets seem to be nervous again in October. That's 2 straight months now of weakness for equities. Can you give us some colour on that?
Well, following on from a strong rebound through the third quarter, especially in tech stocks, which had that amazing August, we did see a turndown in both the US and UK, indeed most markets. The background to this, of course, is that incredibly strong rebound from the March COVID low. But as valuations returned to pre-COVID levels, markets began to ponder a number of variables. Firstly, there's the spectre of new lockdowns that has now come to pass. Secondly, the evolution of policy stimulus to help economies through the COVID pandemic. Pre-election posturing meant that further US fiscal stimulus has been delayed. Thirdly, a vaccine for COVID. Although developments are rapid, we don't see a global rollout in time for winter. And finally, of course, the US election. So all these variables took some shine off that very strong summer equity rally. I should add also that so far in November, we've already seen a strong equity rebound, partly as a correction to that October drop, partly as the US election result proved to be less disruptive to company earnings and bond markets. More broadly, though, the message from US and Chinese economic data has been solid. So there is good reason to have some optimism.
Okay, thanks, Brad. And as you say, this week's US election was a widely anticipated market event. Did it play out as expected?
Well, before election day, markets were expecting one of two results, a very clear win for Democrats, the so-called blue wave, or a very close race and divided Congress. A stronger Democratic showing in pre-election polls led markets to anticipate that blue wave, bringing significant stimulus and a reset on handling COVID-19. Equities rallied and bonds weakened, but the only poll that really matters is the election itself, and the outcome has been close. A divided Congress looks set to continue. At the time of this video, postal votes are still being processed with Republican lawsuits aimed at minimizing their impact. Now, lawsuits are not uncommon in the US election cycle, but concerns over COVID-19 have led to much higher postal voting in this election. The widely held view is that these are tilted in the Democrats' favor, which is why Trump is fighting so hard in the courts. So what does it all mean? Well, the election shows the degree of division in the US, and the likely split Congress means limited policy progress, at least until the midterm elections in 2 years' time. Not great news if you're a passionate ideologue on either side, but perhaps comforting for the moderates. As to what a split Congress means for future US policy, well, Senate control does matter. A narrow Republican Senate majority is unlikely to pass tax increases or large fiscal stimulus spending. A Democratic Senate, on the other hand, would rubber stamp a large package proposed by a Democratic Congress or a Biden White House. Another point, which partly explains the post-election rebound in technology stocks, is that regulatory risks faced by tech sector are reduced in a divided Congress.
So the US election is one uncertainty that's almost out of the way. What are we expecting the markets to focus on next?
In the US, as well as the rest of the world, the policy response to COVID will continue to dominate market thinking. Second wave infections over the Northern Hemisphere will require ongoing support, and we feel that is likely to be forthcoming. We have seen that in recent days, actually, in the UK, with the extension of furlough support. The obvious good news on the COVID front, despite high infection rates, is the lower mortality, as medics have learned how to treat this thing. And vaccines could begin partial rollout in the UK by Christmas. Now, of course, we can't forget Brexit. We are within weeks of knowing if a deal can be clinched between the UK and the EU. Now, the mood music is positive, but hardball politics can still scupper agreement, and we continue to believe a deal will be done. Finally, the China-US tensions, well, they'll come back to the fore again once the US election is concluded. And there are clear issues around geopolitics and security at stake. But we anticipate that the US and China will learn how to accommodate each other. Now, China has a self-interest in staying engaged with the West, even if that means losing its supply chain status to the West. And the US also has a self-interest in helping China to develop its local economy, even if the cost is accepting China's large and growing political importance in the Asian region. US banks, bond and equity investors are all still welcome in China, which needs their expertise to help ensure efficient allocation of capital. And China recognizes that its own capital markets need to change if it is to be successful in boosting domestic demand.
So there's certainly a lot going on in the markets. Against this backdrop, how did the Nutmeg fully managed portfolios perform during the month?
So the higher risk portfolios were down just over 3% in October, and mid-risk portfolios were down around 2%. Now, we are definitely in the middle of a bumpy patch at the moment, which is to be expected from time to time in investing. But as I've mentioned, we are positive about the outlook, and November is off to a very positive start.
So given everything that's happened lately, have you made any changes to the Nutmeg fully managed portfolios?
Yes, in the light of better news on the Brexit front, we neutralised a long-standing underweight to pound sterling. We continue, however, to be underweight UK equities. We also reduced the size of our US Treasury position in October, as they have become just as overvalued as UK gilts.
Our customer question this month comes via YouTube from Chris Carr, who asks, would you consider increasing exposure to China given its economic recovery and Europe's or USA's weak recovery and the fact that more lockdowns are coming?
That's a good question, Chris. I've already spoken a bit about our thinking on the US and China. The COVID issue is a real one, but we think policy measures will continue to be supportive on that front. And meanwhile, we are impressed with both the US and China economic data flow. Now, it's less easy to access China equities directly, but global indices are gradually incorporating more China large cap stocks. The emerging market ETFs that we hold in the fully managed portfolios track these indices. Now, at present, we have a fairly neutral holding in those ETFs. Now, our fully managed portfolios are constantly under review, and if we think the emerging market space deserves a greater weight, we will certainly move in that direction.
Thanks, Brad.
Thanks, Elle.
And thank you for joining us. If you have any questions for Brad or our investment team, or something you'd like answered in our next month's investor update, you can contact us on social media, email, or in the comment section below. We look forward to seeing you next month.